This one's going to be a lengthy video, as technically this is chapter 3, or this is over chapter 3, but I will be incorporating chapter 1 and 2 into this here, chapter 3. It's important to note that chapter 2 is connected to chapter 1, or chapter 1 carries over to chapter 2, and then chapter 1 and chapter 2 carries over to chapter 3. So they're all connected with each other. So I think it's important to actually go over everything that we've covered thus far from chapters 1 and also 2, and then also jump into chapter 3. Okay, so I have these transactions here, and what I'm going to do is take each transaction and I'm going to record them in the general journal using the debits and credits. Okay, so again, this is going to be a lengthy video, so feel free to skip over all the way to chapter 3 if you want to. So transaction 1, the date is January 2nd. Scenario: Bob, the owner of Bob's Consulting Company, contributed cash of $20,000 and equipment valued at $30,000 into Bob's Consulting Company. And from here on out, I'm just going to refer to Bob's Consulting Company as the company. So this is going to be transaction 1, and the date that was provided is January 2nd. So I'll just put 1-2, January 2nd. Okay, so Bob contributed cash of $20,000. So this means that cash is going to be debited for $20,000. Since cash is an asset and we need to increase the balance in that account, we will need to debit it. Okay, Bob also contributed equipment valued at $30,000 into the company. So equipment will be also debited for $30,000 because that's going to increase the balance in that account since equipment is an asset. Okay, since Bob made these contributions of cash and equipment into the business, owner capital is going to be credited for $50,000, which is taking or combining cash of $20,000 and adding it to the equipment of $30,000. So this increases Bob's equity into the business, which is going to affect the owner capital account. Okay, so we are balanced. $50,000 in total is shown on the debit side. $50,000 in total is shown on the credit side. We can move on. Okay, so transaction 2 occurred on January 3rd. The company paid $6,000 in advance to rent out a facility for the next 6 months. Okay, so this is going to be transaction 2, and this is going to be January 3rd. All right, so since the company paid in advance $6,000 to rent a facility out in the next 6 months, this means that they made a prepayment. And so since they made a prepayment, the prepayment is going to go to prepaid rent account, okay, as a debit of $6,000. Okay, prepaid rent is an asset because the company made an advance payment for something that they are going to use in the future. So they have the right to use the facility in the future because they already made the payment for it for the next 6 months. So this is why the prepaid rent account is going to be debited for $6,000 because that's going to increase the balance in that account. And again, prepaid rent is an asset. Okay, so how did they make this prepayment? They made it through cash or by cash for that same amount. Okay, so cash is an asset. Since cash was paid, that account needs to be reduced, and to reduce that account, we will credit it. Transaction number 3 that occurred on January 6th. The company bought office supplies for $500. Okay, so transaction, let me zoom out a little bit. There we go. Okay, transaction 3, and this is for January 6th. Okay, so office supplies was bought for $500. Okay, so we know that office supplies was acquired, which means that office supplies is going to be debited for $500. Okay, office supplies is an asset because it does have value. Now, how was the office supplies acquired? It was acquired by cash. So we're going to credit cash for $500. We are balanced, the debit and credit column, and we can move forward. All right, transaction number 4 that occurred on January 7th. The company received cash in advance of $40,000 to perform services to a client for the next 8 months. Okay, so this will be transaction 4, date is January 7th. So this is going to be pretty much the opposite of this prepaid rent scenario here. Okay, now the reason why this is the opposite of it is because now the company is receiving cash in advance from a client that hasn't performed the services yet, but will perform the services in the future. Okay, so since cash was received in advance, we're going to go ahead and debit cash. It was for $40,000. Okay, so if we go back up here to the scenario, this is cash that was received in advance for $40,000 to perform services to a client in the next 8 months, so in the future. So this cash that was received, the account that's going to be affected from the cash that was received in advance is going to be unearned revenue. Okay, that's going to be credited for $40,000. Okay, unearned revenue is a liability account because now the company is liable to perform the services to this client because the client already made the advance payment of $40,000 for the next 8 months. All right. I don't like how that goes. How that is. There we go. $40,000. Okay. So unearned revenue again is a liability account. Okay, transaction 5. The company performed services to a client for $50,000 for cash. And this happened on January 12th. Okay, so cash was received for $50,000. So we're going to debit $50,000 to the cash account. What was it for? It was for services that was performed. So services revenue or service revenue, I don't know why I say services. Service revenue, which is an actual revenue account, will be credited for $50,000. Transaction 6, January 15th. The company paid salaries of $2,000. Okay, so transaction 6 that occurred on January 15th. So salaries were paid for $2,000. So we know that salaries was paid, which means that salaries expense will need to be debited for that $2,000. How did they get paid? By cash. So cash is going to be credited for that same amount. Okay. I think my writing's getting bigger. All right. Transaction 7 that occurred on January 20th. The company performed services to a client for $60,000 for cash. Okay. So January 20th, cash was received of $60,000. What was it for? It was for services that was performed to a client. So service revenue, the actual revenue account, will be credited for that same amount, $60,000. So this is pretty much this transaction here. Transaction 7 is pretty similar to transaction 5 with the exception of different amounts. Okay, transaction 8 that occurred on January 23rd. The company paid utilities of $300. Okay. So utilities expense will be debited for $300. Okay, how was it paid? It was paid by cash. So cash is going to be credited for $300. So this entry here in transaction 8 is pretty similar to the entry that was made for transaction 6 regarding salaries expense. Lastly, transaction 9, January 26th. Bob withdrew cash of $1,000 for personal use from the business. So January 26th. Okay, withdrew, owner withdrawal is going to be debited for $1,000 because the owner made a withdrawal of what? What did they make a withdrawal of? Cash. So cash is going to be reduced by that same amount. All right. So we pretty much, let me just get rid of that. We pretty much took all of the transactions that occurred from transaction 1 through 9 in the month of January, and we pretty much just translated this English language here into a business language, which is shown here in the general journal. Okay, so the general journal shows you the debits and credits, which again, because I said this in the previous video, the debit and credit columns, this represents the flow of economic resources. Or we say, yeah, economic resources. I was going to say economic activities, but same thing, economic resources. Okay, so the credit column is showing where the economic resources are coming from. The debit column shows where it's going to, or where the economic resources are going to. So that's the significance of the debit and credit columns. All right, so the next thing we're going to do now is fill out the T accounts for each account, which is going to show the transaction effects, or the effects of transactions that occurred in the month of January. So what I like to do is fill out the T accounts by each transaction. So that way I don't miss anything. But you can fill it out based on each transaction, or based on accounts. I like to do transaction by transaction. So this is where my auditor cap comes in, where I just kind of do, I just mark down each thing that I do, or each thing that is already incorporated into the T account. So, all right. So for the first transaction, we have a debit of cash for $20,000. So in the T accounts, on the left side of the T account, it actually resembles a T. That's going to be our debit column. On the right side of the T account, that's going to be our credit column. So I'm going to put $20,000 on the left of cash. Next, I got equipment. Well, let me go ahead and check mark this, indicating that this $20,000 is included in the T account of cash. So this is going to be a tedious process. So if you want to skip over this, if you understand it, how to do all of this, you can definitely skip over this. So equipment, I see a debit of $30,000. Yes, $30,000. So that's going to go on the left side of the T account for equipment. Then owner capital, a credit of $50,000. That's going to go on the right side of the owner capital T account. Okay, and I'm going to do this for all of the rest of, I'm going to do this for the rest of the transactions. So let's see. For transaction 2, prepaid rent has a debit of $6,000. That's going to go on the left side of its T account. Cash has a credit of $6,000. Okay, next, transaction 3, office supplies has a debit of $500. Cash has a credit of $500. Okay, transaction 4, a debit of cash of $40,000. So that's going to go on the left side of its T account. Unearned revenue has a credit of $40,000. Okay, transaction 5, a debit of $50,000 in cash. Service revenue has a credit of $50,000. Next, salaries expense. Let's see. Salaries expense has a debit of $2,000. Cash has a credit of $2,000. Okay, next, transaction 7. Cash is a debit of $60,000. Service revenue has a credit of $60,000. Okay, utilities expense has a debit of $300. Cash has a credit of $300. Okay, owner withdrawals has a debit of 1,000. And then cash has a credit of 1,000. All right. So the check marks means that I've included every single transaction or items into the T accounts for each account. So it's a good little practice there just to make sure that you included every single thing. Now the next thing for me to do is figure out what the ending balance is for each account. And so I'm actually going to start with office supplies and work my way down. And then I'll go back up here to cash, because you notice that cash has a little bit more activity that went on in the month of January. So office supplies, we see there's an ending balance of $500, an ending debit balance of $500. Equipment has an ending debit balance of $30,000. Prepaid rent has an ending balance of $6,000. Unearned revenue has a ending credit balance of $40,000. Owner capital has a ending credit balance of $50,000. Owner withdrawals has a ending debit balance of $1,000. Service revenue, let me scroll up here. Service revenue has a ending credit balance of $110,000. Salaries expense has an ending debit balance of $2,000. Utilities expense has an ending debit balance of $300. Okay. So I'm going to go back up here to cash, and I'm going to get my calculator out, and I'm going to add up the debit column and the credit column. Let's see what it is. So 50,000 plus 60,000 was that minus 6,000 minus 500 minus 2,000 minus 300 minus 1,000. Okay, so cash has an ending debit balance of $160,200, and that's me taking the amounts from the credit column and subtracting them out from the credit column, or subtracting the amounts that's shown in the credit column from the debit column. Okay, so the debit column is greater than the credit column. That's why there's a debit balance of $160,200. Okay, so now, after actually summarizing the transactions for each account using the T accounts, which is also the company's general ledger, we're going to go ahead and prepare the trial balance for this company. And it's going to pretty much display all of the accounts that were used and all of the balances that were associated with the accounts for the period of January, right? So we're going to first start off with our asset accounts. So that needs to be displayed first. And it also, the display is pretty much the accounts are displayed in order of liquidity, meaning that in order of when the cash is converted, when the asset is converted into cash. So the first account that needs to be displayed is going to be cash, because cash is cash. All right. So we're going to just bring this ending balance here, debit balance of $160,200, and we're going to insert it into the debit column. Okay, that's the ending balance as of January 31st. Then we're going to move down to, I can't remember if it's office supplies or prepaid rent as far as which one comes next. Okay, I'm just pretty much going to, let's see, put down prepaid rent. Okay, so we see prepaid rent has an ending debit balance of $6,000. Okay, next I'm going to put in office supplies. And office supplies has a debit balance of $500. Then last we have equipment. Equipment has a debit balance of $30,000. Okay, so equipment is usually the big, it costs more than, you paying for prepaid rent or making an advance payment for rent and office supplies. So this is why it's at the very bottom of the asset list, because it takes longer to convert it to cash. Okay, hopefully that makes sense. All right, so that's our assets here. I believe that's it. So we have 4 assets: cash, office supplies, equipment, and prepaid rent. Great. So assets do need to be displayed first. So I'll just put on here assets. Okay, next we have liabilities that needs to be displayed. And from the transactions that were that occurred, we only have one liability account, which is unearned revenue. So unearned revenue will be credited for $40,000, or it's going to be shown in the credit column here in the trial balance. All right. So that's our liability. Okay, that's the next section that needs to be shown in the trial balance. Then we have our equity accounts, which are our owner capital. Okay, we have a credit of $50,000 there, and then owner withdrawals. Oh, that's okay. I need to, because this is going to have a debit balance, so I need to make sure everything is fit here. All right, there we go. And it's going to be a debit of $1,000. Okay, so this is our equity here. Okay, now we got our revenues and expenses. So we got service revenue, and we have a credit of 110,000. Okay, so that's our revenue. And then we have expenses, which salaries expense. Okay, of 2,000, and then utilities expense for 300. Okay, and this is our expenses. Okay, so when we do the trial balance, again, assets need to be displayed first, then liability, then equity, then revenue, then expenses. Okay, so next thing we need to do is make sure that our debit column, the sum of the debit column, matches the sum of the credit column. So I'm going to start with the debit column, adding everything up. So cash plus prepaid rent plus office supplies plus equipment plus 1,000 of the withdrawals, owner withdrawals, 1,000 plus salaries expense plus utilities expense. So this gives me right at 200,000. Right, nice. Okay, so our debit column has a sum of 200,000, which means that, cross your fingers, the credit column should also have a sum of 200,000. So we're going to take 40,000 plus 50,000 on the credit side plus 110,000. That's going to give us, yes, 200,000. Yes, the moment of truth, and that's what it came out to be. So yes, the debit column matches the credit column, which is awesome. Great. Now, before we move on, I want to just say that just because the debit column matches the credit column, that doesn't mean that everything is correct. Because you can associate the correct amount to the wrong account and vice versa. You can do that and still be balanced. So you're going to be the one to check for accuracy, not this tool here that you're using. So you got to understand you're using this tool, which means that you're the one that has to confirm accuracy, because it can happen. And I've seen it a lot where people would actually be balanced and say, hey, I don't know why, what went wrong. Excuse me. I don't know what went wrong. Got to get a sip of water. I don't know what went wrong, but I'm balanced and it says that something is incorrect. Well, you can be balanced, but you can associate the correct amount to the wrong account, or associate the wrong amount to the correct account. That's possible. Okay. So I just want to throw that out there. Now, when it comes to this trial balance, I want you all to know, let me zoom in here. I want you all to know that this is the unadjusted trial balance. Okay. The reason why this is the unadjusted trial balance is because there are going to be some transactions that still need to be recorded in the month of January or for the month of January. So it happens. I know from my experience, we pretty much will record a lot of transactions in the subsequent period. So, for example, in February for the month of January, and that's because there are a lot of transactions that needs to be recorded for the month of January that didn't get recorded in the month of January at the present time. So that is pretty normal in the accounting world, which means that we are going to have to look at some additional information here. So this is going to be additional transactions here. And I put together, let's see, 1, 2, 3, 4. I think, yep, 4. I don't have 5. And this is just additional information that was provided to, the company that needs to be recorded in the month of January. Now, when it comes to these entries here, you can see here that the dates are all the same, January 31st. These entries are called adjusting entries, and adjusting entries use the end of month date. So January 31st, it is. Okay, so accountants work backwards. So you have to assume that the accountant or accountants that are recording these entries here, these transactions into the company's books, you got to assume that they're recording these in the month of February. Okay, so accountants work backwards to get everything prepared for the previous period. Okay, so pretty much they're getting everything together to make sure that everything is reported correctly in the previous period. So they work backwards. So that's what you have to assume. All right, so here are the additional information here. And we pretty much are going to do the same thing like we did all the way over here. We're going to take this scenario and we're going to record it in the general journal. Okay, so transaction A, letter A, date January 31st. The company used the facility for the first month. Okay, so we're going to put on here transaction A. The date is going to be 1/31. Okay, so the company used the facility for the first month. So if we can remember, the first month here, let's see, transaction 2, January 3rd, the company paid in advance $6,000 to rent out a facility for the next 6 months. So now what the company has to do is make an adjustment on the books to show that they did use the facility for the first month. So come on. I think my computer is not cooperating. So what we have to do is figure out what that monthly expense is going to be. And we're going to by taking $6,000, okay, and dividing it by 6 months. And that's going to give us $1,000 per month that we'll need to expense, okay, from the prepaid rent account. So to record these entry in the books, we're going to credit prepaid rent for $1,000. Since prepaid rent is an asset, we're going to decrease this asset by $1,000. And all we're doing is just moving it into the expense account called rent expense, because we're expensing a month of $1,000 that was used up. So to increase an expense account, we will debit it. Right? That's all we're doing. We're expensing an asset over time because the advance payment was made already. Okay, transaction B. The company has $200 of office supplies still on hand. All right. So I'm going to set the journal up here. Transaction B, August 31st. Let me erase this. I don't want to get too close together. Space it out a little bit. I don't know what's going on with my handwriting, you all. All right, there we go. So it says that the company still has $200 of office supplies pretty much on account. That's what they still have as of January 31st. So if we go back here to the initial transaction of office supplies, okay, we see that the company on transaction 3, January 6th, the company bought office supplies for $500. Okay, the entry was to debit office supplies for $500, credit cash for $500. Now it's saying that here that $200 is still on account. This means that we're going to have to take $500, subtract out $200 because that's what's still on account to get $300. Okay, $300 is what we're going to have to record in the company's books to bring the office supplies account from $500 down to $200 because that's what's still on hand. So for letter B, it's just like the prepaid rent example. The account that's going to be credited is going to be office supplies. It's going to be credited for $300. Okay, office supplies is an asset, and this amount is going to be moved over to an account called office supplies expense for that same amount. Oh, did I put 300? No, this, oh yeah, that's right. Sorry. That is correct, $300, okay? So I'm expensing the office supplies that was used up in the month of January, all right? Okay, yeah, this video is long. Again, you all skip through it if need be. So January 31st, 1 month of services was performed to a client that already paid cash in advance on January 7th. Great. So let me go ahead and put the entry together. Now let's go back over to January 7th just to see what they're talking about. Okay, January 7th. All right, so transaction 4, the company received cash in advance of $40,000 for services to be performed to a client for the next 8 months. So that entry here was a debit to cash for $40,000, credit to unearned revenue for that same amount. So if we go back over here to the transaction, so transaction C says that 1 month of services was performed. So what we have to do now is figure out, okay, how much does 1 month of service worth? What needs to be recorded in the books to reflect that month of services that was performed? And so to do that, we're going to take 40,000. That was the cash that was received in advance, and divide it by 8 months because it's for the next 8 months. And that's going to give us $5,000 a month. Okay, so this means that whenever a service is performed, $5,000 would need to be recorded in the books. Now, how? I'm going to show you. So this $5,000 is going to be first debited to the unearned revenue account. Okay, why is that? If we go back over here, if it would have let me, there we go. We credited unearned revenue for $40,000 to reflect that there's a liability on the account of the company for the cash that was received in advance. So the company is liable to perform future services to this client. So once part of the services is performed in this case, which 1 month's worth of services was performed, we're going to have to reduce the unearned revenue account by 5,000. And yes, unearned revenue is a liability. So when you debit a liability, you are reducing the balance in that account. Okay, and we're just going to move this amount to the actual revenue account called service revenue. So this is an actual revenue account, and it'll be for a credit for $5,000. So it's the opposite of the previous 2 entries here that's happening. The previous 2 entries is an example of prepaid expenses being expensed, and then this letter C, or transaction C, this is a example of unearned revenue that's being actually transferred into the actual revenue account. All right. Okay. Last one. So what? Transaction D. Salaries were accrued for $15,000. Awesome. All right. So letter D, January 31st. Okay, so salaries is accrued for $15,000. So whenever you see something that says accrued, that means that either an expense or revenue is accrued, even though the cash has not been paid or received yet, respectively. So accrual means that something happened, but you haven't received or paid cash yet. So you have to report the revenue or expense in the books because it actually occurred, but the cash hasn't been received or paid yet. All right. So in this case, salaries were accrued for $15,000. This means that you had employees that actually worked, but they haven't been paid yet. But what you have to do in your books, you're going to have to accrue it. You have to report it. You have to recognize the expense in your books. So salaries expense will be first debited an amount of $15,000. And the other account that's going to be credited, not cash, because cash hasn't been received. We see accrued in the transaction there. So salaries payable is going to be credited for $15,000. Okay, payable is a liability account. You will also see something that maybe say accrued expenses. Okay, accrued expenses or accrued liabilities. Some companies you may have companies, I can't say some, I'm not sure, but you can have companies that will use accrued expenses or accrued liabilities as an account to put in or to record the salaries in their books. Okay, it depends on the complexity of the company, the size of the company. So, it just depends on that. So if it's a really small company, they probably wouldn't have a separate salaries payable account. They probably would just put it all in the accrued expenses or accrued liabilities account. But just so you know, it is a liability account. All right. So I think I'm talking too much. And now what I'm going to do here is pretty much just update the T accounts. That's it. So first thing I'm going to do is, you notice that all of these T accounts are blank. And what I'm going to do is just update it. I'm going to move the balances in these T accounts that you see here from the T accounts that was already prepared. And all we're doing is we're just updating the company's ledger. That's it. Okay. So for cash, we have an ending balance of $160,200, and that's a debit balance. So I'm just going to go over here and put in $160,200. So $160,200 on the left side. So we're just pretty much starting with that because we pretty much are just transferring the balances in the I want to say the old general ledger into the new general ledger. Okay, if that makes sense. All right, so supplies, $500 debit balance. Okay, that's going to go on the left side. Equipment, we have a debit balance of $30,000. Prepaid rent, we have a debit balance of $6,000. Unearned revenue, we have a credit balance of $40,000. Okay, owner capital is a credit balance of $50,000. I remembered, so I don't have to scroll back over. Owner withdrawals had a debit balance of $1,000. Okay, service revenue, I believe it's 110,000 as a credit balance. Let me go back and see just to make sure. Yes, 110,000. Salaries expense, debit balance of 2,000. Utilities expense, debit balance of 300. Okay, salaries expense 2,000. Utilities expenses 300. Okay, so I pretty much transferred all the balances into the new or updated T accounts. Okay, so now the next thing we're going to do is, we're going to update some accounts. We're going to update the balances in some accounts given the adjusting entries that were made for transaction A through D. So some accounts may not be affected, but you have a few accounts that will be affected. That's okay. So transaction A. So rent expense has a debit of $1,000. Okay, so I'm going to go to the T account for rent expense, put in a debit of $1,000 or put it on the left side of the T account. Then prepaid rent has a credit of $1,000. So I got to find a prepaid rent T account. There it is. I'm going to put the $1,000 on the right side of the T account. So I'm just going to put a check mark here indicating that we've included the amounts into the T accounts for transaction A. Those accounts. Letter of transaction B, office supplies expense, debit $300. So go to office supplies expense T account. And this is going to be a debit of $300. Office supplies has a credit of $300. So go to the office supplies T account, put $300 on the right side of it. We're good to go. Transaction C. There's a debit of $5,000 in unearned revenue. So we go to the unearned revenue T account, put the $5,000 there. Service revenue has a credit of $5,000. Put the $5,000 underneath the right side of the T account of service revenue. Okay. Then transaction D, we have a debit of $15,000 in the salaries expense account. $15,000 is going to go on the left side of the T account. Then salaries payable is going to be a credit of $15,000. So I'm going to put in another T account here for salaries payable. It is a liability, so this is going to be a $15,000 credit. So that's going to be on the right side. Okay, so we're good to go. We're updated the T accounts for some of the accounts. Okay, so pretty much let's update the balances here, the ending balance. So cash wasn't affected, so it has a, let me zoom in here so you can see it better. It has a debit balance of $160,200. Office supplies, that did change from $500 to $200. So office supplies has a ending debit balance of $200, taking $500, subtracting out $300. That's on the credit side. Equipment didn't change. That's a $30,000 debit balance. Prepaid rent did. That's a debit balance of $5,000. Okay, taking $6,000, subtract out $1,000. Unearned revenue changed from $40,000 to $35,000 as a credit balance, taking 40 minus 5. Salaries payable has a $15,000 credit balance. Owner capital didn't change. That's $50,000 credit balance. Owner withdrawal, $1,000 debit balance. Service revenue, that did change to $115,000 credit balance. Salaries expense did change to $17,000 debit balance. Utilities expense did not change. That's a $300 debit balance. Rent expense, $1,000 debit balance. And then office supplies expense, the newly $300 debit balance. Okay. Okay, so we updated the T accounts. Now, the next thing we need to do is put together the trial balance again. Okay, so we're going to have to update the trial balance with it pretty much is going to include everything that happened in the month of January. All right. So this trial balance indeed will be called adjusted because this does include all of the adjusting entries that were made after the month of January has ended. Okay, so I'm going to just do the same thing. I'm going to just pretty much put account, debit, and credit. Okay, first thing we're going to do, let me zoom in a little bit. There we go. I'm going to grab the cash account and put in $160,200 in the debit column. That didn't change. Next thing I'm going to do is put in prepaid rent. That has a debit balance of $5,000. Okay, we're looking at the ending balances here. Next, we got office supplies for $200. Then we have equipment for $30,000. Okay, these are our asset accounts. So I just put on here assets. Okay, next we have liability accounts. And I'm going to put in unearned revenue. Okay, it has a balance of 35,000 as a credit balance. Then salaries payable. Salaries payable have a credit balance of 15,000. So these are our liabilities. Okay, next we have our equity accounts. That didn't change, so owner capital has a credit balance of 50,000. Owner withdrawals has a debit balance of 1,000. Okay, that's our equity. Then we got revenues. Service revenue, that's the only revenue account. So service revenue is going to be for 115,000. Okay, that's revenue. And then we have our expenses. So we got two new expense accounts here. So we got salaries expense, 17,000. Utilities expense. Oh, I spelled it wrong. I'm not going to get away with that. I'm not going to continue on. I got to change that. All right, utilities expense, $300. Rent expense is $1,000, and then office supplies expense. I can tell my computer's overheating. All right, $300 debit balance. All right. So these are our expenses. Now, the moment of truth. I'm going to sum up the debit column and the credit column. And they do need to balance. They need to match each other. Okay. So that's what I'm going to do. So get the cash amount plus the prepaid rent plus office supplies plus equipment plus owner withdrawals plus salaries expense plus utilities expense plus 1,000 plus office supplies expense. Okay, so debit column shows a 215, 1,000 total. This means that 215,000, cross your fingers, is the sum of the credit column. So I'm going to take 35,000 from the credit column plus 15,000 plus 50,000 plus 115,000. And yes, the credit column also has a sum of $215,000. Okay. Awesome. Usually with accountants, I know for me, from my experience, when you're balanced, it's a priceless feeling. All right. So this is it. So this is the updated trial balance here. I'm going to zoom in so you can see. This is the adjusted trial balance. Now it includes every single account and also the amounts that were associated in those accounts for the month of January. And that's pretty much chapter 3. So let me just scroll down a little bit so you can see everything. And also scroll back up. And then zoom out so you can see it from a macro view, macro level. Okay. What you see here are step-by-step processes. All right. So if it lets me scroll over, which is kind of not letting me, there we go. My computer is kind of overheating. I'm just going to scroll over here one more time. And that's it. All right. So that's chapter 3, and I hope this was helpful.